And I'm Mira.
So before we jump right into today's deep dive, we just want to make it absolutely clear to you, the listener, that our discussion today is purely for market context and analysis.
Right, yeah. This is definitely not personal investment advice.
No, not at all. Not an investment recommendation.
Exactly. We're really just here to help you understand the macroeconomic baseline that you're operating against right now.
Yeah, and what a baseline it is, honestly. So it is the evening of Friday, July 3rd, 2026.
Heading right into an extended holiday weekend?
Yep. And our mission today is basically to recap the market news from this past week. We have this huge stack of market logs and, macro thesis documents.
It's a lot of material.
It is. And our goal is to just extract the most important nuggets of knowledge so that you are fully prepared for the opening bell on Monday.
There is just a tremendous amount to unpack today. I mean, we've got shifting Federal Reserve expectations, some really severe reality checks in the AI space, and geopolitical tensions that are physically reshaping supply chains.
So let's officially kick off session one.
Let's do it.
The core question for session one is, how did the major asset classes actually perform over the past week as we headed into this long holiday weekend?
Well, if you just glanced at the headlines, it was a week of stark divergence, honestly.
Yeah, very mixed.
Because if you were just looking at the Dow Jones, you might think everything in the economy was smooth sailing.
Right. The Dow showed incredible resilience. It just kept steadily marching upward to hit a high of 52,900.07.
And the broader market held its breath pretty well, too. I mean, the S&P 500 swung around a little bit.
But it stabilized.
Yeah, exactly. It stabilized, closing Thursday's cash session right around 7,483.24.
But then you look at the tech sector, and it is a completely different universe.
Oh, it really is. The tech-heavy NASDAQ 100 suffered this massive, just headline-grabbing reversal.
It is brutal.
We're talking about a severe intraday collapse on Thursday. It fell nearly 1,000 points from its high.
Wow.
And it eventually closed at 25,832.67.
Almost 1,000 points. You see a drop like that, and the immediate reaction is usually like, okay, the sky is falling, everyone is panicking, sell everything.
Right, but here's where I actually have to challenge that panic narrative a bit.
Okay, why?
Because if you look at the VIX, the volatility index, which Wall Street basically uses as a fear gauge, it actually fell this week.
Wait, really?
Yeah, it went from 17.65 on Monday down to 16.15 on Thursday.
Wait, I'm stuck on that. The NASDAQ drops 1,000 points, which sounds like an absolute bloodbath, but the fear gauge goes down.
Yep.
That feels completely backward. Walk me through that logic.
I know it sounds totally counterintuitive, but you have to remember what the VIX actually measures.
Right.
It primarily tracks expected volatility in the S&P 500, which represents the broader market, not just tech. So what happened Thursday wasn't some blind panic or a massive market-wide liquidation where everyone just rushed to cash.
It was more of a rotation.
Exactly. It was a calculated, orderly rotation.
So the money wasn't leaving the casino, it was just moving to a different table.
That's a great way to put it. Capital was moving out of those high beta, mega cap tech stocks, the ones that bounce around the most, and finding a safe home in defensive blue chip companies.
Right.
We're really seeing the classic mechanism of, discount rates as valuation gravity at play here.
Yeah, and for those who might be new to that concept, you could basically think of interest rates like physical gravity on a stock's price.
Exactly.
When rates are high, gravity is heavy. It pulls down the valuations of tech companies because they rely heavily on earnings that are far out in the future.
And when rates ease up, that gravity lessens.
Right, allowing other non-tech sectors to float higher and catch a bid while those tech multiples just sort of consolidate.
Perfectly said. And that rotation story makes complete sense when you look at the rest of the board over the week.
Yeah, like over in the bond market.
Exactly. Treasury yields drifted noticeably lower. The 10-year note futures settled down at 109.55.
And meanwhile, in commodities, crude oil just plummeted.
Really good.
WTI crude fell to around $68.78, and Brent crude is barely holding near $72.13.
Which acts as a massive relief valve for inflation expectations, Cheaper oil means cheaper transport and cheaper goods.
Definitely. But the really fascinating move to me, honestly, was in precious metals. Gold staged a massive surge.
Oh, totally headline-worthy.
Yeah, it jumped from Thursday's close of 4,112.70 all the way to a pre-market high of 4,208.30 on Friday.
And while gold was surging, the U.S. dollar index actually softened down to 100.86.
Right, and that was mostly due to Japan, wasn't it?
Yeah, it was largely because Japanese officials started issuing some very stern verbal intervention warnings. They're trying to prop up the yen and effectively talk the dollar down.
So if we synthesize all of that, the defining characteristic of this past week was basically capital fleeing the high-flying tech names and rotating into defensive blue chips, bonds, and gold.
Exactly.
All right, so that wraps up our recap of the week's market movements. We'll take a really quick break, and when we come back, we'll dive into session 2 and the massive macro news that triggered all of this.
Stick around.
Welcome back. Let's get right into session 2.
Let's do it.
So to frame this session, the question is, what were the critical news developments that broke over the holiday, and how do they alter the macroeconomic baseline we're operating against?
Right. And to give some immediate context, we have to look back at the watch next items from the most recent trading session on July 2nd.
Yeah, the market was already bracing for some heavy data.
Exactly. People were waiting for the June ISM Services PMI and the S&P Global PMIs coming up on Monday, July 6th, as well as some upcoming Treasury bill auctions.
But the real earthquake hit on Thursday morning at 8:30 a.m. Eastern Time.
The June employment report.
Yes. It was shockingly weak. I mean, the U.S. economy added only 57,000 jobs.
And the forecast was for 113,000.
Right. They missed by half.
It's a massive miss, and it instantly altered the macroeconomic baseline. Traders looked at that 57,000 number and immediately pushed their expectations for the next Fed rate hike out from October all the way to December.
Because the labor market is finally showing that deep cooling the Federal Reserve has been waiting for.
Exactly. But here is the paradox, right? While the macro picture was cooling down, the micro picture in the tech sector was completely overheating.
Which brings us to the massive AI capital expenditure reality check that hit the wires this holiday weekend.
Yeah, this is where the AI narrative really starts to fracture.
So Meta CEO Mark Zuckerberg held an internal town hall.
And he made a pretty stunning admission, honestly. He told his staff that AI agent development over the last 4 months has been much slower than expected.
And he didn't stop there, did he?
No, he admitted that the massive $700 billion tech capex cycle we're seeing across the industry is putting a severe strain on Meta's financials.
He essentially said their stock price would probably be higher if they weren't spending all this money on AI infrastructure that just isn't paying off yet.
It's a sobering moment. I mean, the market has been treating AI infrastructure spending as a cycle-agnostic arms race.
Meaning companies will just keep buying chips no matter what the economy does.
Exactly. But we saw a structural shift with NVIDIA this week that challenges that whole assumption.
Yeah, they announced a new highly aggressive commercial model.
They are essentially providing credit support and financial backing to help specialty AI cloud providers acquire their GPUs. And in exchange, NVIDIA gets a direct share of their cloud hosting revenues.
Okay, I actually have to push back on how this is being spun in the financial press right now.
Oh, really?
Yeah. I mean, NVIDIA is framing this as an innovative partnership, but honestly, this looks exactly like vendor financing as shadow demand.
Walk us through what you mean by shadow demand there.
Well, think about it like a car dealership. Imagine a dealership paying for your gas, your insurance, and your first year of monthly payments, just so they can tell Wall Street they sold a car today.
Ah, I see.
Is that real sustainable demand, or is it just an illusion? If NVIDIA has to lend its own customers the money to buy its incredibly expensive GPUs, that suggests the end market demand is drying up.
Right.
If these cloud startups can't monetize fast enough, we're risking an earnings collapse that will completely override any benefit we get from interest rate cuts. I mean, a rate cut in December won't save a tech company that blew its balance sheet on servers nobody's renting.
That is a very real structural risk. You're basically bringing future revenue forward while hiding the current credit risk.
Exactly.
And speaking of hidden credit risks, let's talk about SoftBank.
Oh, the margin loan.
Yeah, they are currently negotiating a $10 billion margin loan backed by their stake in OpenAI. And they're working with major players like JPMorgan Chase, Goldman Sachs, and Mizuho.
Which is terrifying when you think about the actual mechanics of it. Can you explain to the listener how a private tech company's valuation dropping suddenly becomes a massive public banking problem?
Sure. It all comes down to collateral. A margin loan basically means SoftBank is borrowing cash and using its shares in OpenAI as the collateral to guarantee the loan.
Okay.
If OpenAI's private valuation takes a hit, say, because this AI capex cycle slows down the value of that collateral shrinks.
Right. The banks want their money secure.
Exactly. JP Morgan and Goldman Sachs aren't going to just sit there. They will issue a margin call demanding SoftBank put up more cash immediately.
And where do they get that cash?
Well, to get that cash, SoftBank would be forced to liquidate its public blue-chip stock holdings, like its massive stake in Arm.
Wow.
And that flood of selling crashes public markets. That is how a private venture capital stumble instantly becomes public market contagion.
The lines between private risk and public stability are just completely blurring.
They really are.
And layered on top of this financial friction is some intense geopolitical friction. We learned this week that Anthropic and Alibaba are actively closing tech loopholes that were allowing Chinese companies to access the Claude AI model.
Yeah, the tech containment walls are definitely getting higher.
Now, to be fair, it wasn't all doom and gloom in tech. Tesla actually beat their Q2 delivery estimates, pushing out 480,126 vehicles.
But even they are tightening their belts. They instituted a strict internal cost-cutting measure, capping employee AI spend at just $200 a week.
Which is wild. Even Elon Musk is watching the cloud bill.
It perfectly illustrates the tension right now. Everyone wants the AI, but nobody wants the massive bill that comes with it.
Right. So let's pivot slightly from digital power to physical power. Let's look at geopolitics and energy risks, because that is the other massive weight on the market right now.
The situation in the Strait of Hormuz is incredibly tense.
Yeah.
We have this fragile 60-day U.S.-Iran ceasefire in place, but Fitch Ratings issued a warning this week that corporate shipping risks are lingering precisely because Israel is not participating in this agreement.
And we are seeing physical naval movements in response. France and the UK have deployed mine countermeasures and frigates to secure navigation in the region.
While Iran is essentially demanding transit fees from vessels passing through the strait.
It feels like random chaos to me, honestly, like an unpredictable natural disaster hitting global supply chains.
Well, I actually have to challenge that reflex.
Okay, why?
It is so tempting to view geopolitical flare-ups as unpredictable chaos, but if you look at it through a game theoretic lens, this is a highly calculated leverage play.
A leverage play?
Yeah. Iran demanding transit fees and European nations seemingly accepting that those fees are an inevitable cost of doing business isn't random. It's a deliberate strategy to exert control and extract economic rent from a global choke point.
Ah, I see.
They know exactly how much pain the global inflation narrative can tolerate before someone intervenes. It's leverage, not chaos.
That is a great point. They are essentially testing the boundaries of the inflation threshold.
Exactly.
And speaking of energy leverage, Russia took a major hit this week. They announced they are cutting their daily foreign exchange purchases by half.
Because the price of Urals crude collapsed 60% from its March peak.
Right. Yep, it's trading under $45 a barrel at Western ports.
So their oil revenue is drying up due to global oversupply and sanctions, but they are still projecting force militarily. Russia launched a massive missile strike that severely damaged critical energy infrastructure in Kyiv, causing widespread power outages.
It really highlights how physical energy infrastructure has become the ultimate strategic target right now.
It really has.
Which ties perfectly into our final major theme from the holiday weekend: global central banks and the physical limits of our power grids.
Yeah, because despite the cooling U.S. jobs data we talked about earlier, global central bankers are remaining stubbornly sticky on policy.
Right.
San Francisco Fed President Mary Daly was out this week advocating for a gradualist approach, and she actually warned that the AI investment shock itself could be inflationary because of all the physical infrastructure it requires.
And in the UK, the Bank of England reported that business inflation expectations are actually ticking up. Expected own price inflation hit 4.1%, and wage growth expectations rose to 3.5%.
The European Central Bank is also remaining highly vigilant. Their officials are refusing to commit to further rate cuts despite the recent drop in energy prices.
And this higher for longer interest rate regime is also facing intense political pressure. Former President Donald Trump gave an interview criticizing the Federal Reserve Board, calling them hostile, and specifically challenging the position of Governor Lisa Cook.
And as a reminder to you listening, we report that purely to impartially convey the facts in our source material.
Exactly. Political pressure on the Fed is a vital variable that bond markets have to price in, regardless of what side of the political aisle it comes from or what your personal views are.
Absolutely. The bond market doesn't have a political party. It only cares about risk.
Right.
Now, let's bring all this high-level macro theory back down to physical reality, because while the market was busy debating AI software multiples and Fed policy, the physical U.S. power grid was quietly maxing out.
Yes. This is the story that really caught my eye. An extreme heat wave triggered maximum generation and load management alerts across the PJM interconnection, which is the largest electrical grid in the U.S. right through the July 4th holiday.
Wow.
They likely hit record high power demand just trying to keep the air conditioners and the data centers running.
And that physical grid stress directly translated to the market. It pushed utility stocks, specifically the XLU ETF, noticeably higher.
Investors are suddenly realizing just how valuable and strained our baseload power generation really is.
Yeah, you cannot run a 1 gigawatt AI data center on intermittent power. You need constant, reliable electricity.
So to summarize, the holiday news was essentially a massive collision. We had AI valuation reality checks, sticky global inflation pushing against a weakening U.S. jobs print, and the hard physical limits of our energy infrastructure all crashing together.
It's a lot to digest.
It is. We're going to take a really quick break, and when we come back, we'll dive into session 3.
See you in a minute.
All right, welcome back. Let's start session 3.
The big question now is, with all these macro cross-turns, what exactly do we need to watch in the coming week?
Yeah, looking at next week, we aren't just blindly reading the calendar. We're on high alert for inflation and labor data that will either prove or disprove everything we just discussed.
Exactly.
First thing Monday morning, July 6th, at 9:45 a.m. Eastern Time, we get the S&P Global Final Services PMI for June.
And then just 15 minutes later at 10 a.m. Eastern Time, the ISM Services PMI for June drops. Given the inflation stickiness, that prices paid subindex is going to be heavily scrutinized by the bond market.
On Tuesday, July 7th, at 8:30 a.m. Eastern Time, we get the U.S. trade balance for May.
Wednesday, July 8th is a big one.
Very big.
At 2 p.m. Eastern Time, the FOMC meeting minutes are released. We'll get to see exactly how divided the Federal Reserve really is right now regarding that cooling labor market versus sticky inflation.
And finally, Thursday, July 9th, at 8:30 a.m. Eastern Time, the weekly jobless claims for the week ending July 5th will hit. After that miserable 57,000 jobs print we got this week, every single labor metric is absolutely critical.
It is going to be a tense, data-heavy week. Which is why, as a Sunday night reset for everyone listening, I think we need to consult the holiday recap joke.
Oh, absolutely. We all need a psychological reset after watching tech multiples consolidate while sweating through a record-breaking heat wave.
Seriously.
So here is the thought for the week. We're heading into Monday hoping the fragile Hormuz ceasefire holds together better than our local power grid and that the massive global AI capex cycle actually delivers a real return.
Fingers crossed.
Tomorrow, we get to see if the AI boon is the future of human productivity or just a very expensive way to heat up a data center. May your coffee be strong and your portfolio's terminal growth assumptions remain unquestioned.
A very expensive way to heat a data center. That is just painfully accurate right now.